Welcome to the Daily Drawdown, where today's pressure points are AI economics, market rotation, and oil risk. The biggest story right now is that AI is getting cheaper to build, harder to monetize, and more expensive to support. At the same time, markets are rotating out of crowded winners while geopolitics is pushing energy risk back into the tape. Chinese open source models like Kimi, K3, DeepSeek, and Alibaba's releases are narrowing the capability gap with top US models, and in some short windows, they're even leading on token usage metrics. What matters is how they're doing it. These systems are being trained on older or less advanced chips and squeezed harder with techniques like mixture of experts and distillation, which cuts cost sharply. That puts pressure on the middle of the market first, routine use cases, pricing tiers, and any buyer that mostly cares about acceptable performance at a much lower bill. The limit is trust. US labs are accusing some Chinese firms of harvesting outputs, distilling proprietary behavior, and using questionable data sources, so enterprise buyers still face IP, security, and governance risk. The practical read is that capability is converging faster than enterprise adoption. Sensitive demand may still stay with domestic hyperscalers and major labs, even if the raw model gap keeps shrinking. Token cost and intelligence per dollar are becoming the real scoreboard. A model that looks cheap to train can still be expensive to run if it burns too many tokens per answer. That's already showing up in budgets. Some companies have cut AI bills dramatically by moving to open source, while others found usage exploded faster than expected as teams adopted more tools and larger models. That's the Jevons effect in plain English. Lower unit costs can increase total demand, so cheaper AI doesn't automatically mean a smaller market. It can mean the opposite. One development to watch is outcome-based pricing. Instead of charging by token, vendors charge for a completed support task, a qualified lead, or some other business result. That makes AI easier to budget and ties spend to value. The strategic implication is simple. Model access alone is not a moat. Durable advantage is shifting toward proprietary data, embedded workflows, customer relationships, and contracts that protect who owns the data and the outputs. On hardware, the fight is moving beyond raw chip speed toward model-specific integration. Alphabet's Frozen V2 is the clearest example, embedding parts of Gemini into silicon for major efficiency gains, with reports ranging up to roughly tenfold. The trade-off is flexibility. If you hardwire a model approach into a chip, you're betting the architecture stays relevant for years, and these deployment timelines stretch well into the decade. At the infrastructure level, companies like AMD are pushing rack-scale systems that bundle compute, networking, and software, trying to capture more of the data center stack. NVIDIA still dominates, but the market is broadening around the edges. The adjacent winners may be less obvious. Analysts are turning more constructive on memory and optics, arguing AI demand is creating a multi-year tight supply cycle, especially in memory, with pricing support, even as some chip categories commoditize. The financial tension is now front and center. Hyperscaler Capex is consuming roughly 95% of operating cash flow this quarter by some estimates, and could move above 100% by year-end if spending keeps climbing. That means the next proof point is earnings, not ambition. Investors want to see backlog converting into revenue, cloud growth sustaining, and clear monetization through new services, pricing power, or higher revenue per user. If that proof shows up, the market can tolerate extreme build-out. If it doesn't, valuations get harder to defend because free cash flow pressure could last into 2027. There's also execution risk on the physical build. Data center protests are spreading. Some localities are considering or imposing moratoria, and power, permitting, and construction complexity are driving cost overruns. Oracle's disclosure of multi-billion overruns is the warning shot here. It raised financing questions and reminded investors that AI infrastructure spend is not just a demand story, it's a project execution story. In equities, leadership is broadening. Investors are rotating out of concentrated mega-cap AI exposure and into financials, industrials, healthcare, small caps, and equal weight or value setups. Part of that is simple diversification after a long run in a handful of names. Part of it is AI fatigue, where momentum got crowded and even good news stopped producing easy upside. Small caps have become a real expression of that shift, helped by stronger earnings growth expectations in parts of the universe. A defensive barbell is also getting attention: healthcare and defensives on one side, selective growth on the other. Separate from fundamentals, leverage is adding noise. Leveraged funds and heavy options activity in names like Nvidia and AMC are amplifying intraday moves, and retail call buying frenzies can turn routine repositioning into sharp swings. Geopolitics is the other pressure point. US-Iran strikes and continued military action have raised the risk around key maritime choke points, including the Strait of Hormuz and Bab el-Mandeb. That has already pushed Brent above $90 briefly in reporting and lifted U.S. gasoline prices toward $4 a gallon. With strategic petroleum reserves seen as historically low, the cushion against a supply shock looks thinner. For markets, this matters well beyond energy. Higher fuel costs act like a tax on consumers, and they hit at a time when credit data still shows strain beneath decent headline retail and labor numbers. Roughly 6 in 10 households are still described as living paycheck to paycheck, so higher gas and food costs can quickly pressure discretionary categories, especially restaurants and lower-end retail. That risk is reinforced by the food safety scare around lettuce shipments. Even with the FDA saying one positive test was a false positive, foot traffic dropped fast, which shows how quickly ambiguous health signals can hit consumer-facing businesses. One constructive regulatory development came in crypto. The OCC approved Circle's National Trust Bank Charter, giving stablecoin custody and institutional services a clearer banking framework ahead of broader stablecoin regulation. If the Genius Act and related market structure rules land as expected, that could deepen institutional integration of digital assets, especially around payments and custody. The near-term watch list is straightforward: AI earnings for monetization proof, memory and optics for supply tightness, oil for escalation risk, and whether market rotation broadens or snaps back into the same crowded AI leaders. That's the brief for today from the Daily Drawdown. Stay focused on what's actually converting to cash and what's just consuming it. This episode was generated by Podkey. Create your own at podkey.fm.